September 2008, Lehman Brothers, a 158-year-old bank, collapses overnight. The Dow plunges 504 points in a single day. In the weeks that follow, $8 trillion in stock market value evaporates. Millions of Americans lose their homes and life savings. But here's what they don't tell you. Take a look at this chart. This chart represents the losses between the top of the stock market in October of 2007 and the bottom in March of 2009. It represented a 56% loss to the value of stocks, which meant if you had a $100,000 portfolio like I did at the time, you would have found the value of that portfolio going from $100,000 to less than $50,000. But now let's scroll out a little bit further and let's take a look at what happened after. Because when you take a look at what happened in the years that followed the 2008 financial crash, well, you start to see that the story isn't as bad as it seems by looking at that mere short period of time when stocks plummeted. In fact, since that fateful day when the S&P 500 hit its lows, it has returned an astonishing 777%, meaning that if you just stayed in the market or gotten into the market when things seemed to be at their very worst, you not only would have survived, but you would have thrived. This is what happens after every financial crisis. And every financial crisis in history has had a secret second act. While the masses focus on the chaos, a select few understand that the real story isn't about what's being destroyed, it's about what comes next. What I'm about to show you is the hidden pattern that emerges after every major financial disaster, a pattern that repeated itself after the Great Depression, after the dot-com crash, after 2008, and will happen again after the next crisis. This isn't about predicting when markets will crash, but understanding what happens in the aftermath, when most people are paralyzed by fear, but the greatest opportunities of a generation are hiding in plain sight. The next few minutes could change how you see financial crises forever. But before we get into it, my name's Nolan Matthias, and if you want the truth about finances, and you believe that in every crisis lies opportunity, then you're going to be surprised by this next scary stat. And that's that only 4% of people who watch these videos is actually subscribed. So if you genuinely do believe that crisis equals opportunity, then do me a favor, hit that subscribe button. Okay, so let's get into it. Let's discuss why crises matter. Every crisis creates a ripple effect that's felt for decades. Whether that is the psychological effect or the financial effect, a similar pattern emerges in every single crisis. Whether it was the Great Depression in 1929 or the financial meltdown of 2008, the question is, why do some people thrive after a crisis while others falter? And the answer to this question is surprising. And we're going to talk about that a little bit later on. But first, this is what you can expect from this video. We're going to talk about how to navigate and leverage post-crisis opportunities. We're going to talk about the immediate short-term and long-term effects of when things get really bad. And we're going to talk about the importance of preparation and understanding financial history. Because if you understand financial history, then you have significantly more opportunity than those who don't. And that could allow you to make really good choices during the next financial crisis. And those choices could lead you to having a portfolio worth millions and millions of dollars. If you just choose not to follow the herd mentality and not make the same mistakes that everyone else will make. So let's start by talking about the immediate aftermath of a crisis. What happens in the financial markets? Well, first and foremost, markets remain volatile with unpredictable swings. There are ups, there are downs, and it's impossible to tell exactly when the bottom of the market is. And in almost all cases, these sharp declines that happen, like on that date in September of 2008, when the Dow lost over 500 points, there's almost always short-term rallies. Now, many people will try to time these rallies and make a quick buck. But the secret is not in timing the market. It's in what you do with your long-term strategy, which we'll talk about a little bit later on. But the fear that comes from these sharp ups and downs creates opportunities for strategic buyers. The type of buyers who buy the exact right things at the exact right times, knowing that in the long run, the value of those investments is going to return significant dividends. And I don't just mean the type of dividends that pay you out income, I mean the type of dividends that create massive amounts of wealth. Then there's the societal impacts. Unemployment during a financial crisis will inevitably surge as businesses cut costs. And as a result, consumer confidence will plummet, and that will impact the amount of spending, which leads to an even worse recession as money starts to stick closer to the pocketbook instead of being spent on things that will help the economy return. And then the credit markets freeze, making borrowing difficult. It doesn't matter what type of financial crisis it is, banks tighten up their books and make lending more difficult, which eventually makes spending more difficult at both the business and the personal level, which causes things to basically freeze out in the economy for an extended period of time, usually multiple years. And with the uprising in the social impacts, of course, there's going to be a governmental impact. Governments step in with stimulus packages, knowing that if they don't, things could get significantly worse like they did during the Great Depression. Then, if there's bank issues, there will almost certainly be bank bailouts. We've seen this recently. And this is designed to make sure that liquidity stays present in the market so that there isn't a systematic collapse. And then, of course, all of the things that led to the financial crisis will lead to new regulations that aim to prevent a recurrence, but also impact business practices, making it significantly more difficult for certain types of businesses. And that ultimately will lead many companies to go into bankruptcy, which leads to industry consolidation, as companies who are set up to thrive swoop in and buy undervalued assets of their competitors. And at the same time, we see entrepreneurs adapt with necessity-driven innovations. How many companies have been started in the middle of a financial crisis purely out of necessity? I mean, just take a look at my buddy Pat Flynn from Smart Passive Income, who when he lost his job in 2008, had no other choice but to take on entrepreneurship. And he now runs a multi-million-dollar company that teaches people how to adapt in times of crisis. And then there's the changing consumer behavior, which obviously has an effect on businesses, as those businesses who sell goods that aren't necessarily a necessity start to struggle, while companies like Walmart and McDonald's start to thrive as consumers look for cheaper options. But eventually we start to see an economic recovery across different sectors. Technology is almost always an early rebounder in a time of crisis. Then there's things like consumer staples, which relative to every other industry tend to do incredibly well because, well, they're a necessity. And then there's real estate. Now, in real estate, the recovery depends on the location and the type of real estate, whether it's residential or commercial. But at the end of the day, real estate tends to be one of the first things to recover after things get really, really bad. And with the crisis, new business models emerge. For example, there was a surge in e-commerce after 2008, with companies like Amazon and Shopify taking advantage of the shift in consumer habits. Then, as we saw after the pandemic, health tech took off as telemedicine and remote patient monitoring tools were on the rise. Then, we also saw things like green energy take off. Companies like Tesla not only disrupted the automotive industry, but took it over. And last but not least, the gig economy, which led many people who had lost their jobs to look for other sources of income, using platforms like Uber, Airbnb, and even Upwork and Fiverr to make money on demand. Now, in the medium term, economic recovery begins unevenly across sectors. Gold and commodities tend to ride the wave of fear. As we saw post-2008, gold surged for 3 or 4 years after the crisis. And after the pandemic, we saw the same sort of thing. But what's interesting is as there becomes more certainty around what's going to happen in the economy, gold and commodities can take a nosedive, as they did after President Trump was recently re-elected. But the big thing is that innovation is sparked during these crises. We see the emergence of new business models catering to the post-crisis needs. We see industries like technology and healthcare often lead the recovery. And we see companies that have the ability to bootstrap lead the way as tighter lending practices reshape borrowing practices. There's a growth in alternative investments, and banks innovate with stricter yet consumer-friendly solutions, putting the emphasis on lending to consumers rather than focusing on big companies who have a significant amount of uncertainty. But this is where the real secret comes into play. It's the wealth opportunity. It's recognizing value. It's identifying the undervalued stocks with strong fundamentals. Think back to 2008, when Ford went to $6, and when Starbucks became one of the best buys it had ever been in history, as even the lines at Starbucks were filled with construction workers who probably should have been choosing a cheaper form of coffee to drink. And then there was companies like Amex, who took a nosedive during the financial crisis, but who were obviously set up to do very well once everything got back to normal. There was significant value available in almost every stock at every turn. The question was, how do you identify those stocks and choose the right ones to buy at the right time. And wait until you see what one strategic investor did after the Great Depression. I'm going to show you that a little bit later on. But here's the real secret. It's building a diversified portfolio for long-term resilience, something like the all-weather fund, where you can take opportunities like a stock market crash to rebalance your portfolio and essentially make off like a bandit, selling assets that in times of maximum fear go up in value in order to buy assets that in times of maximum fear go down in value and are at bargain basement prices. Because post-2008, the S&P saw over 400% growth in a decade. And in the 15 years since, that growth has almost gotten to 800%. And you need look no further than guys like Warren Buffett, who seized the opportunity to buy undervalued assets immediately after the 2008 financial crisis. Berkshire Hathaway went on a buying spree, as did many other massive investors. In fact, most of the fortunes that were made outside of the tech industry after 2008 were made by savvy investors who seized those very opportunities. So let's talk about how to leverage those opportunities. Let's talk about the lessons from history. Let's talk about John Templeton's approach during the Great Depression, where he bought every single stock priced under $1, which in today's dollars is about $22, investing $10,000 and turning it into $40,000 in just 4 years. Then we have Amazon's rebound post-dot-com bubble, where they took advantage of all the companies that had collapsed, seized the opportunity to not only become the #1 bookstore in the world, but the #1 online seller of pretty much everything. And here's the key. Coming out of a financial crisis, you need to focus on the industry's position for growth post-crisis. But the question is, how do you do that? And the answer is John Templeton's very strategy. So let's talk about John Templeton's key investing rules. These are the rules that will allow you to take advantage of a crisis and make a fortune. So let's start with the core principles. Invest for real returns. Focus on total real returns after taxes. Immediately after a crisis is not the time to be going out and investing in companies without a proven track record. You want to focus on companies that are undervalued, that will have significant upside in the future based on an established business model. Then rule number 2 is to keep an open mind. Stay flexible. Shift between popular and unpopular methods. If something like Bitcoin or gold has everybody flocking towards it, look towards the more unpopular investments that are being sold at a discount. And rule number 3 is to never follow the crowd. Superior results require going against the majority. And I can tell you right now that a significant amount of the people who are investing in gold, just as we're hitting the point where the fear is starting to go away, are probably going to lose a significant amount of their money. Then rule number 4 is everything changes. Always expect that if one type of investment is doing really well, there is going to come a time where that stops. And when there's a bear market in the industry, there's probably a bull market right around the corner. And I'll show you how to see where the bear and bull markets are in a second. Rule number 5 is to avoid the popular. Popular methods eventually lose effectiveness. Things like putting every penny into Bitcoin, putting every penny into gold are trends that eventually will die, just like the trends in GameStop and AMC and the whole Wall Street bets trend. Rule number 6 is to learn from mistakes. Recognize patterns. Avoid costly this time is different thinking. Thinking that this time is different for gold and that there isn't going to be a major correction is the definition of stupidity. Then rule number 7 is to buy during pessimism. Maximum pessimism is the best time to buy. Just look at March of 2009 when the S&P 500 hit its lows and the potential for returns after that. Rule number 8 is to hunt for value. Focus on value rather than trends. Look for the companies that have a proven track record and buy those. Then rule number 9 is don't just stick to your local markets. Search worldwide. Diversify globally to find better bargains. Most people don't realize that the original reason that the BRICS were named the BRICS was because of an investment strategy that looked at emerging markets. And to this day, it still makes sense to invest in those emerging markets if you can find the really good value investments that almost certainly exist. And rule number 10, and this is the most important one, no one knows everything. True wisdom comes from understanding the limits of knowledge. And just because you believe that something is going to go up in value indefinitely doesn't mean that you shouldn't be hedging your bets. An investor with all the answers doesn't actually understand the questions, the most important questions to ask, which is where's the value, can this last forever, and how do I take advantage of it? And when it comes to understanding where the opportunity is, quite often the opportunity is in the sectors that aren't performing as well as they should. And a great way to see exactly what is happening here is to look at sectors and figure out where the pain is. You can do that simply by looking at the heat maps of stocks over the last year. And if we sort this out, to look at the sectors based on where the most pain is, it becomes really apparent that there are certain places you can go right now to find great bargains. Industries like health and technology services, and process industries, to name a few. But at the end of the day, understanding what happens after a financial crisis is what will lead you to be able to take advantage of it when it happens. And not only take advantage of it, but be prepared for it. Because it's in these times where fortunes are made. And if you can go against the crowd, not follow the herd, and take advantage of the fear that inevitably exists during the worst of times, you can not only survive, but thrive. Oh, and by the way, if you want to see what always happens before a financial crisis so that you can see it coming, make sure you check out this video right here.